Introduction to CFDs. In this video, you will learn what are CFDs, types of CFDs, advantages of CFDs, disadvantages of CFDs, and example on CFDs. Let's start. What are CFDs? CFD stands for Contract for Difference, which is a financial derivative product that allows traders to speculate on the price movements of various underlying assets without actually owning them. In a CFD, two parties, the buyer and the seller, agree to exchange the difference in price of an underlying asset from the time the contract is opened to the time it is closed. CFDs allow traders to potentially profit from both rising and falling markets since they can go long or short on an asset. For example, suppose you are interested in trading the stock of company XYZ, which is currently trading at $100 per share. However, you don't want to purchase the actual shares, but instead want to speculate on its price movements using CFDs. You decide to enter into a CFD trade on company XYZ with a contract size of 100 shares. The CFD provider offers a leverage of 110, meaning you only need to deposit 10% of the total trade value as margin. In this case, the total trade value would be 100 shares multiplied by $100 per share equals $10,000. Since you are only required to deposit 10% as margin, you would need to have $1,000 in your trading account. Now, let's consider two scenarios. Scenario 1, bullish expectation. You believe that the price of company XYZ will increase in the near future. Based on your analysis, you decide to go long on company XYZ CFDs. Suppose the price of company XYZ rises to $110 per share, reflecting a $10 increase. As a result, the CFD price would also increase by $10 per share. Since you have a contract size of 100 shares, your profit would be $10 per share multiplied by 100 shares equals $1,000. In this scenario, your initial investment of $1,000 would have generated a 100% return thanks to the leverage provided by the CFD. However, it's important to note that if the price had gone down, you would have incurred losses in proportion to the price decline. Scenario 2, bearish expectation. Alternatively, let's consider a bearish scenario where you expect the price of company XYZ to decline. In this case, you can go short on company XYZ CFDs. Suppose the price of company XYZ drops to $90 per share, reflecting a $10 decrease. The CFD price would also decrease by $10 per share. As a result, your profit would be $10 per share multiplied by 100 shares equals $1,000. In this scenario, even though the price of company XYZ declined, you were able to profit from the trade by selling the CFDs at a higher price and then buying them back at a lower price. Types of CFDs. There are several types of CFDs that traders can trade, depending on their preferences and investment goals. Here are some of the most common types of CFDs. Index CFDs. These are CFDs that track the overall performance of a market index, such as the S&P 500 or the FTSE 100. Commodity CFDs. These are contracts for difference that enable traders to speculate on the price movements of commodities such as gold, oil, or wheat. Forex CFDs. These are contracts for difference that allow traders to speculate on the price movements of currency pairs, such as the EUR-USD or the GBP-USD. Cryptocurrency CFDs. These are CFDs that track the price movements of cryptocurrencies like Bitcoin, Ethereum, or Litecoin. Advantages of CFDs. CFDs offer several advantages to traders and investors. Here are some of the key advantages of CFDs. First, leveraged trading. CFDs allow traders to access leverage, which means they can control a larger position with a smaller initial investment. This amplifies potential profits, as gains are based on the full value of the underlying asset, while only a fraction of the total value is required as margin. Second, diversification. CFDs provide a wide range of underlying assets, including stocks, indices, commodities, currencies, and more. This allows traders to diversify their portfolios and spread risk across different markets. Third, market access. CFDs enable traders to participate in various global markets, including international stocks and indices, without the need for direct ownership of the underlying assets. This provides greater flexibility and the opportunity to take advantage of market movements across different regions. Fourth, no ownership costs. When trading CFDs, you don't actually own the underlying asset, which means you don't have to pay for expenses like storage, maintenance, or dividends. This can be beneficial for traders who are primarily focused on price speculation rather than long-term investment. Fifth, liquidity. CFDs are generally highly liquid instruments, meaning there is usually a large number of buyers and sellers in the market. This makes it easier to enter and exit positions at desired prices, even in volatile market conditions. It's important to note that while CFDs offer potential advantages, they also involve risks. While CFDs offer some advantages, they also come with several disadvantages that you should be aware of. Here are some of the disadvantages of CFDs. High risk. CFDs are leveraged products, which means that you can gain or lose a significant amount of money relative to your initial investment. The use of leverage amplifies both potential profits and losses, making CFD trading a high-risk activity. If the market moves against you, you may lose more than your initial investment. Volatility risk. CFDs are particularly sensitive to market volatility. Rapid price movements can result in significant gains or losses in a short period. Volatile markets can be unpredictable, making it difficult to accurately predict price movements and increasing the risk of substantial losses. Counterparty risk. When you trade CFDs, you do so with a CFD provider or broker. There is a risk that the provider may not fulfill its financial obligations to you. If the provider becomes insolvent or fails to meet its contractual obligations, you may not receive the expected profits or even lose your entire investment. Costs and fees. CFD trading involves various costs and fees that can erode your potential profits. These costs may include spreads, commissions, overnight financing charges, and other fees imposed by the broker. It's important to consider these expenses when calculating your overall profitability. Then let's use an example to make you understand CFD more clearly. Assume that the current market price of Apple shares is $150 and you have $1,000 to invest. Trading Apple shares. If you decide to purchase Apple shares directly, you can buy approximately 6.67 shares. In this case, you become a shareholder and own a fraction of Apple's company. As a shareholder, you may be entitled to dividends and have voting rights in the company's decision-making processes. If the price of Apple shares increases to $160 and you sell your shares, your profit would be the difference between $160 and $150 multiplied by 6.67, which equals $66.70, excluding any fees or commissions. Alternatively, you can trade Apple CFDs with the same $1,000 capital. Let's assume the CFD broker offers a leverage of 1 to 10, meaning you can trade with 10 times your initial investment. With a 1 to 10 leverage, your total trading capital becomes $10,000. You decide to open a long CFD position on Apple shares, speculating that the price will rise. Each CFD contract represents 1 share of Apple. If the CFD price reflects the market price accurately, you can buy approximately 66.67 CFD contracts. The movement of the CFD price closely mirrors the movement of the Apple share price. If the CFD price increases to $160 and you close your position, your profit would be the difference between $160 and $150, multiplied by 6.67 equals $66.70. Excluding any fees or commissions. However, it's important to note that with leverage, potential losses are also magnified. In conclusion, it is important to recognize that while CFDs offer potential advantages, they also come with inherent risks. Thanks for watching. If you liked this video, be sure to hit that subscribe button and turn on notifications so you never miss a video.